This is Unit 3, Lesson 2, and let's have a look at prepaid expenses and what it entails. But first, just let's understand together why we need to make year-end adjustments. Mistakes happen in the recording of transactions, wrong accounts, wrong amounts, etc. So we need to correct the mistakes and therefore have correcting entries. And then we need to adjust for our income and expense items so that they reflect in the correct period. Now we have the beginning of a reporting period and the end of a reporting period, which equals a 12-month period. It could be from the 1st of March to the 28th of February of the following year, or any other 12 months like 1st of January to 31st December. We want to make sure that the income and expenses that we include in the accounting records relate only to this period, and that we have included all of them even if they have not yet been paid. So that is why we make year-end adjustments. Prepaid expenses is an example of an expense that we have paid upfront, and a part of that expense does not relate to the current reporting period. So let's have a look at the following example. Entity A has a 31st December year-end. On the 1st of November, they paid an amount of $60,000 in cash for the rent of the office building, and according to their contract, they have to pay the rent for 6 months in advance. So let's go and plot this on a timeline. Our current reporting period is 1st of January to 31st December. And here on the 1st of November, we made the payment for 6 months, meaning that 2 months fall in the current period and 4 months in the next reporting period. So take note that on 1st of November, we made the following entry. We said debit rent expense of $60,000 and credit the bank with $60,000. And it is the 4 months that is included in that rent expense account that we are concerned about. The following calculation needs to be performed. We want to calculate the 4-month period that we now have to go and remove. In order to do that, we take the $60,000 that was paid and divide it by the period that it was paid for, the 6 months. Now we calculate the amount that must be excluded, which is the 4-month period, and that relates to $40,000. The following journal entry will then be performed. We will say debit prepaid expenses of $40,000 and credit the rent expense of $40,000. So we are effectively creating an asset named prepaid expenses. And the thinking is that we are still owed the service of the rent for which we have already paid for. And when we are owed something, that is an asset. The credit of the rent expense account will then mean that only $20,000 is left over in that account, which is correct because that is the 2 months rent for the current reporting period.